What's up, everyone? It's Caddy with Money Vesting. So, the stock market here so far in 2023 has held up really well. Not on the back of hedge funds, not on the back of institutional funds or institutional investors, not on the back of retail traders either, but instead, what's keeping the markets afloat is the companies themselves. So there was a report that came out in Wall Street Journal today. There was some really interesting data point shared and some collective insight that I wanted to break down in this video that I think is going to be very, very useful in our understanding on what's actually happening behind the curtains and what's, where the liquidity, where the volume is actually coming from when it comes to the markets themselves. With the S&P up, NASDAQ, Dow Jones, everything up year to date, with a lot of individual stocks also higher. And I'm not saying that this is not driven by retail and institutional. Sure, there might be some retail traders collectively, obviously, very, very over enthusiastic, over optimistic about the markets, with interest rate expectations kind of pegged at somewhere around 5 to 5.25%, and then expecting a pause and a cut. But a lot of that volume, which is obviously driving the markets higher, is coming from the companies themselves in the form of stock buybacks. Yes, so share repurchases have been growing in 2023. A lot of companies have actually announced share buyback programs in 2023, but I wanted to kind of bring out some of the data points, some of the more insights into what's going on behind the scenes here. So, it's obviously been stock buybacks, but the companies in S&P 500 is projected to get up to over $1 trillion by 2023. I think last year it was just over $981 billion, especially on a trailing 12-month basis. According to the S&P Dow Jones indices, and authorizations for repurchases are picking up pace. And as of February 17th, they totaled more than $220 billion, a record for that point in the year. Just think about that for a second. $220 billion of pretty much buybacks. And according to Goldman Sachs analysis and S&P 500 and Russell 3000 companies, and among the biggest share repurchase announcements have been Chevron's $75 billion buyback program. We got $40 billion plan from Meta, and Goldman Sachs also announcing a $30 billion authorization. Not to mention Apple and Microsoft and Google and some of these big tech companies have consistently been buying back shares on a more regular basis. Now, buybacks continue to be robust and provide a bow for individual stocks in the market broadly. And when a company buys back its own shares, obviously creates a lot more demand. It is reducing the supply in the market and thereby increasing the share price and also increasing the earnings per share, because you're working with a lower supply, lower amount of shares outstanding. So net income divided by shares outstanding gives you an EPS, earnings per share, and that also increases if the companies are buying back shares. Corporate clients at Bank of America, so this was the study, have repurchased about $13.5 billion worth of shares on a net basis this year so far. According to the lender's equity flows data released on Tuesday, and that is tracking roughly in line with last year's record levels and compares with about $9 billion of net outflows from hedge funds, institutional investors, and individual clients. So this right here was the table that they shared in conjunction with FactSet, and what you'll notice is Bank of America equity client net flows 2023. This is as of February 17th, 2023, so just about 10 days ago, but I'm sure this has only gotten, more and more in line with corporates here. Corporates obviously being the big leaders, and this is only Bank of America we're talking about, right? Their corporate clients. Like imagine if you were to combine the entire report from Goldman and JP Morgan and all corporate clients that these companies have. But this right here is the big net inflow coming into the market with hedge funds, very, very small amount. Institutional have still been net outflows, and retail, surprisingly, has also been a little bit of net outflows, even though we have seen in a separate report that retail has pretty much plowed money into the market in 2023 with respect to Tesla, Nvidia, a lot of individual stocks. And again, I'm not saying those companies have only gone up because of corporate buybacks, but a lot of the market has kind of stayed afloat or obviously pushed higher because of the amount of buybacks that we're seeing. And this right here is going to be some other reports. So what you'll notice is mega cap technology companies were among those spending the most on buybacks in the last 3 months of 2022. Apple spent roughly $19.5 billion on stock repurchases. So think about how the markets have been doing since October of last year. And Meta Platforms buying back $6.9 billion and Microsoft repurchasing over $5.5 billion of its stock. And to some investors and analysts, a slowdown in stock repurchases in the fourth quarter actually signals good news for fans of buybacks. And there has also been a 1% federal tax on buybacks that took effect on January 1st from President Biden, which obviously there's been a lot of debate, and even Warren Buffett himself talked about it, which I'll go over later in the video, but he was not happy about the share buybacks having a 1% federal tax on those buybacks, right? So obviously that's something that, Warren Buffett pretty much used some nasty words to explain the situation. But going over to buybacks on a cumulative basis and on a trailing basis here, $981.6 billion on the last 4 quarters kind of summed up. And this is, again, as of the third quarter 2022. This new data will be updated once Q4 is completely over in terms of earnings. But take a look at where we are coming from. Back in 1999, 2000, this number was really, really low. In fact, it was under $300 million. Then we got up to as much as $700 million in 2006, 2007. Dipped quite a bit when stock buybacks pretty much fell during the great financial crisis. And since then, it's just been increasing and going higher. The companies are also giving out more and more dividends, $563 billion in dividends paid out in the last 4 quarters. This right here, again, an insane amount. And this number is going to hit over $1 trillion in 2023. Now, this is going to be based on different sectors, and what you'll notice is communication services more recently has picked up in the share buybacks, so such as Google and Meta and some of these companies, but majority of it has been coming from information technology. IT, of course, Apple and Microsoft being the big giants for share buybacks, and then some industrial companies, healthcare companies. We've also got financials doing consistent buybacks, utilities, not so much, real estate only recently, energy, again, not so much. Again, recently though, Chevron's been buying back shares, and materials also not so much. And communication services, like I said, only recently. So these are some of the sectors that have been buying back shares. Most of it has been coming from financials, IT, consumer discretionary, so your Amazons and some of these other companies that are in the discretionary sector, industrials and healthcare, and now other sectors are also picking up. This is going to be the cumulative buybacks since the first quarter of 2009, and what you'll notice is that every single sector, cumulative buybacks are going higher. So more and more companies are putting capital to use by buying back their own shares. And take a look at communication services. Absolutely wild how parabolic this thing has gone in recent times. Healthcare, consistent increase, almost about $1 trillion in cumulative buybacks. We've got industrials at $734 billion. Then we've got IT at over $2 trillion. So again, there's no comparison when you compare IT to any other sector. IT, you've got so much buyback. Even real estate, $17.6 billion, pretty non-existent. We got utilities at $27 billion, financials $1.2 trillion, energy $360 billion, staples at just over $500 billion, consumer discretionary over $960 billion, and then overall total buybacks cumulative at over 7.5, almost 7.6 trillion dollars. Trillion with a T. That's how much companies have bought back shares in terms of dollar amount since 2009. Wild, absolutely wild. And then moving forward, this right here is going to be on that 1% excise tax that President Biden recently proposed, quadrupling in his State of Union address. And Warren Buffett pretty much wrote in the annual letter, and I quote, "When you are told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or silver-tongued demagogue," which is pretty much a political party. I had to look that up. It's like a political leader that has some prejudice over certain parties, and it's really, going after the taxes and the profitability as opposed to looking after the average consumer and the people that are voting them in the office. So characters that are not mutually exclusive, wrote Mr. Buffett, and the new tax isn't devastating, but it is especially harmful to a company like Berkshire Hathaway. So they do a lot of buybacks. They don't pay a dividend. And they don't have a pretty significant capex either. So what they do is they pretty much buy back shares every single year in the form of, just repurchases. And that's one way for them to return cash to shareholders, right? So what they mention is Berkshire is unusual because it uses buybacks to reward shareholders, not executives, and it pays no dividend, using repurchases as its only way of returning cash. So bottom line is that companies are plowing money into their own shares as fast as possible and as much as possible so that they can reduce the supply. Obviously, they're on a more surface level, earnings per share can be seen as growing because year over year, there might be some growth there because you are increasing the earnings per share, because it's one of the ways how you can artificially increase your earnings per share, right? Because of the lower share count, you're increasing your earnings per share. But the real situation really is, we have to look at whether companies are actually growing their net income. That's why I also focus on net income, right? Net income is a good comparison on a year-over-year basis as opposed to simply looking at the earnings per share, because earnings per share, you can do a lot of tweaks, a lot of different things to kind of make it look a little bit different. So net income is what I think is going to be a more important indicator for growth year-over-year. But bottom line is that companies are keeping their own stock and, of course, the markets as a whole afloat as much as possible right now in 2023 and even since fourth quarter of 2022. So I hope you guys enjoyed this video and complete update on this particular topic. Make sure that you drop a like, subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us, there is a 16% annual discount that is available and valid for the end of this February month. And if you want to take advantage of that, that's going to be second link down in the description below. As always, happy investing, and I'll see you all in the next video.